For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, ERS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrek is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrek. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrek even though you haven't received a final response yet. Sidrek first checks the eligibility of your claim. For example, is it within Sidrek's claim limit? Is it against a member of Sidrek? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. 2 outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrek then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrek's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrek will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrek will close the case. So let Sidrek help start the conversation towards resolution. For more information, visit sidrek.com.my or call 03 2282 2280.
Bursa Malaysia has been part of the Malaysian economic growth for over 4 decades. We have been working relentlessly to create a transparent, efficient, and vibrant stock exchange.
While we've been working at building a vibrant marketplace, inclusivity and contributing towards economic growth, we have also channeled efforts and resources towards supporting the community at large. Shares to Share is one such effort, which has been developed to create positive impact towards society and the environment. To put it simply, Shares to Share is a transparent and easily accessible facility that enables investors to donate their listed securities or proceeds from the sale of their listed securities towards charity through Yayasan Bursa Malaysia. You can donate odd lots or even board lots. The funds from the sale of these shares will be channeled to approved charitable organisations and their respective initiatives or projects.
Bursa Malaysia has waived its portion of the transfer fee, clearing and trading fees for all transactions that are conducted under Shares to Share. The participating brokers of Shares to Share have also agreed to waive their portion of the transfer fee and brokerage. The charitable organizations that have been selected have undergone the necessary due diligence process and have been duly approved by an independent selection committee.
At least 500,000 populations live with some kind of disabilities. They are most of the time being left behind. We need to empower them, otherwise they will continue to be the liability. A lot of human resources wasted from this group of people.
We provide a lot of support for persons with disability who are young adults and adults. We have a social enterprise called Project I'm Possible, where we managed to hire all persons with learning disability to work here. We have a cafe, bakery, weaving, and we have an art gallery.
Purity of thought, word, and deed, that is action, is very important to be really successful. We must know some skills to be able to help us then paperwork. The grant from Shares to Share will be used for, one is sewing, handicraft, classical dance, and so on.
Our patients have to be fed, they have to be looked after. We look out for any sort of disease they might develop, and also those unforeseen circumstances. Thanks to Bursa's initiative, we can be a little bit easy on our patients and their family members.
Donations will all be channeled to organizations that are involved in the sustainable development of Malaysia. The Shares to Share scheme offers you the chance to do so in a simple and effective way.
Bursa's Shares to Share allows us to do good by donating our shares to charities. You join us in making a difference to the society by donating your listed shares.
Shares to Share is open to all donors, individual as well as corporates or other types of entities. You can transfer your listed securities via Bursa Anywhere app at a click. For more information, please visit our Bursa Malaysia website.
Good evening, everybody. Welcome to this webinar brought to you by Bursa Malaysia that is titled Breaking Down Financial Reports. So welcome, everybody. My name is Shin Chu. I'm the moderator for this webinar. Now, as you know, fundamental analysis is a cornerstone when it comes to analyzing a fundamental aspect of the company, be it qualitative and the quantitative aspect of the business. It is very essential for us to learn fundamental analysis so we can identify investment grade companies or companies with good growth prospect that can include in our portfolio. Today, our topic here is breaking down financial reports. So our speaker will delve deeper into financial reports so we can make sense of a number and be able to dissect financial statements to the bone. So before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any financial decisions, you're 100% responsible for all your investment risk. Now, allow me to introduce our speaker today very briefly. He first indulged himself in the SME financing industry after finishing his diploma in finance and investment in TAR UMT. He was a former risk and compliance officer with Rakuten Trade and also the dealer representative with TA Securities. To date, he has just passed 7 years in the capital market as an investor himself, where he also had the opportunity to run the financial blog One to Invest with over 60,000 followers since 2019. He has hosted close to 50 interviews with public listed companies in Bursa Malaysia as well as NASDAQ, and had been featured on Xinqiu, Nanyang, China Press, City Plus FM, and Caijing. Currently, he's also a SGX Academy speaker. So he's none other than Mr. Max Tan. Max, how are you today?
Hi, Shane. Thank you for the kind introduction here, and good evening to everybody. I wonder if anyone can tell, I actually kind of lost my voice and I'm recovering from a certain disease, but hopefully it won't affect the the sharing session for us today. Hopefully I can share with everyone on how to actually break down financial reports so that you can understand the company deeper, and we will try to actually go into a couple of case studies of the company quarterly reports today, although I do not have my full voice here, so apologies for that, and hope you can bear with it.
Yep, thanks for speaking with us, even though your throat is still very itchy. Appreciate that.
No worries.
Okay, just speak slower, right? Make sure you don't cough.
Okay, I'll try to control it and try not to impact the whole session. So let me share my screen now. Okay. As Shane introduced just now, this is my profile. And again, once again, disclaimer, whatever investment decision that you guys made throughout this session or after the session, will be fully responsible on your own. Now, before that, let's go back a little bit on, breaking down the financial reports. So why is it so important for us to go to study the financial reports? Because it reminds me that when a couple of years back, like 5 or 6 years back, that's when the concept of passive income is widely known, where there are a lot of so-called programs, a lot of courses that promotes the concept that you only need to study a company once and you reap the benefit for the rest of your life. So it's essentially you're sleeping at home, but you collect the income from the company in the form of dividend or in the form of capital gain, whatever it is. So in that sense, I would have to say it's partially incorrect, because if you do not follow on the developments of a company, a lot of times you will miss out on a lot of opportunities for you to capitalize. For example, to buy cheaper during COVID times, to take profit. And if the company, the fundamentals has gone haywire or gone to the wrong direction that you initially wish it to go, then if you don't follow it up, you will miss out a lot of opportunities there. Opportunity cost to not follow on the company through financial reports, one of the best way to follow on the company, will be too big. The opportunity cost will be too huge for everyone. So it's really important for you to actually dive down on financial reports on the company that you follow, on the financial performance, whether it hits your initial expectations. And if it doesn't hit the expectation of the public, it normally shows quite obviously on the share price reflection on the second day. Let me give you an example. If let's say a technology company with a high PE, price to earnings ratio, now if the company does not hit the expected earnings level of the market, let's say 30 times PE, maybe the market expect it to grow at 30% on year-on-year basis. If it doesn't grow at that quantum, perhaps the share price will reflect the second day, which will drop. And a lot of people, especially for new investors, they think that going through the quarterly report is just going through the numbers. But in a matter of fact, in the quarterly report, normally they will have a lot of extra notes like prospects of the company. When we mention about prospects of the company, it doesn't mean that it's only for the company itself. Let me give you an example and a sort of a little bit of a trick that I use. Let's say if I buy company A in the glove, for simplicity's sake, in the glove industry, the company announced their quarterly result in, let's say, 2nd of August. Then it shows that the financial performance of that company is lackluster. Maybe it's not doing well because of selling prices, whatever the reason might be. But in fact, in my portfolio, I'm holding company B. So what do you think I should do when I see that company A in their quarter report already say that, oh, actually the industry is not doing so well? So you can actually capitalize on opportunities like this to, to understand the prospects of the whole industry and not limited to the company itself. Then if you are back to the same case study, if company A is saying that, okay, the industry is not doing well, and let's say that if I hold company A itself, then I can cross-check with company B. Let's say the next day company B announced the results, and actually company B is doing quite well. So I would know that the problem not lies in the industry itself, but rather on company A itself. Then I know I will dive deeper to understand what is actually the reason for this company itself is not performing as compared to the whole industry. So that's an opportunity for you to cross-check across the peers when it's result season. Now it's raining quarter reports in this month itself. You see more quarter results coming out maybe in the 18 onwards until 30th, 31st is holiday, so 30th of August. And sometimes when you go through all the quarter reports available, I'll show you where to look at all the quarter reports. You might be able to identify some of the good investment prospects. For example, if you see a company is showing consistent or very impressive year-on-year growth, so normally that will, I'll get interested. I'll go and click on the quarter report, then I go and check what is actually going on in the company. Or sometimes companies, they deliver bad single quarter earnings due to one-off reason, which we will explain a little bit on when we try to digest the quarter reports. You might find some unexpected investment opportunities. So the more financial reports that you read, then the more familiarized you will get with all these investment opportunities. There are more opportunities coming to your way. And also, last but not least, you get yourself kind of updated to the market. You understand that what is actually going on in the market itself, and so that you can sort of predict the upcoming financial performance of any companies that you're investing in. So it's very important to keep yourself updated. So yeah, with that in mind, so let's start a little bit in the easier way for beginners. So where do we look for financial reports? There are actually quite a number of sites that you can look for. Obvious one is you go to Bursa Announcement, which is the quickest one, because all the other sites, they actually grab the data from Bursa Announcement themselves. So Bursa Announcement is the quickest. Then Malaysians' favorite Galaxy Screener. I think for most of the investors, you would have Galaxy Screener installed on your mobile phone. And a lot of people, they also like to use Malaysia Stockbase, which is not bad as a platform. Pick a Stock, quite comprehensive. It's a new platform. Probably a lot of you haven't heard of it, but you can go and check it out. And obvious choice is another one, i3 Investor, where a lot of us hang out and debate or talk on the forum itself. Okay, but of course the utmost priority and the quickest source of information, most accurate one, is of course Bursa Announcement, right? But when we talk about Bursa Announcement, how do I actually look for financial reports? Actually quite simple. Just go to Google and then you type in Bursa Announcement, then you will reach this page. And there are parts on the where I box it up. You can select the company you want to know. Let's say Capital A, which is quite a lot of investors got interested due to the share price, or maybe AX, or maybe some technology company like Dufu, and then Frontcan. Then results just came out not long ago. So in category, you can type in financial results. There you go. You will be updated with all the latest. If you don't select the company name, then they will show you a whole list of latest quarterly report announced by the companies. But of course, if you select a company, then they will show you the company you selected, right? So let me quickly go through. And cash flow screener, relatively simple. Just this is the web version of it. Just click on financials. Again, they will show you the whole list of financial results that had came on. Okay, financial. Then you will be presented by this page, which is quite similar. And also they did a bit of a visualization, so it's easier for you guys to, actually have a brief understanding of what's going on. For example, like a DPRH, what happens? The results of the company suddenly jump by 131%. So naturally, if you're interested in the company or you are the investor of the company, you'll be interested to learn a bit more. Then you can click on the, sorry, I didn't box it up, but on the furthest right side, you can see that there's an arrow. If you click on it, it will lead you to the document that has been uploaded to Bursa announcement website actually, right? That's for cash flow screener. And upcoming one, we have Malaysia Stockbase. All these websites, you can just type in Google and you get access to it for free, absolutely free. So for Malaysia Stockbase, I think a lot of web user, they also love to use Malaysia Stockbase because literally when you go into the website, they show you all the latest financial results that has come up in the box over here. But it depends on whether you think it's user-friendly in terms of the UI, whether you like it or not. So again, if you click on the numbers, let's say click on the 34% by UPE, then it will lead you to another page where you can see the financial performance, the actual quarter report of the company or the number that you click on, right? So next one, probably not a lot of people know, Pickstock. If you want like Malaysia Stockbase, I think they offers a paid premium version. But of course, if you just want to look at the quarter results, then here you go. Sorry, the alignment a bit off. But on the box area is where the quarter report announcement is out. So you can actually have a check on it on Pickstock. Then last but not least, a lot of users that like us, we also hang out around in i3Investor, just to look at how people would comment on the company itself. So how they actually look for quarter results in i3Investor. So what we do is scroll down and until you see this part, again, it should say that financial results. So you box it up and you will be presented with, all these options that you can click on. Year-on-year growth. I will mention in a bit later why year-on-year growth is so important and why all these websites, they offer QQ growth and also year-on-year growth. What does it mean for our company itself, right? So with all these avenues and tools presented to you, so now the most important part, what do you actually look for in financial reports, right? So the first thing, obvious reason, the statement of profit and loss. So why do you need to look at the statement of profit and loss? For obvious reasons. Why do you want to invest in a company? Because the company is expected to give you returns. But how does the company give you return? There's two ways. One, in a form of dividend. When a company issues dividend, normally, normal scenario is that the company is consistently making profit, is generating cash flow, so that the company is giving you additional cash or extra cash generated from the business to reward you as a shareholder. Now, there are cases where there will be one-off dividend, a very huge sum of a dividend. For example, Litruck that sold the highway asset, you get a very, very huge dividend, but that is normally not the usual case for Bursa companies. So the second way that you can profit it from a stock is that the company itself is growing. So the share price of a company on natural basis, it will also increase. So you will need to check on the statement of profit and loss to actually see that whether the company is consistently making profit or has it gone into loss, and most importantly, whether the company is it growing as compared to year on year. Let me for a minute. Okay, so since we're here, let me talk a bit about year on year and quarterly basis. Now, when we see YOY, it means that comparison to the year before. So let's say we are in quarter 2, 2023. I will compare the same quarter, which is quarter 2 in 2022, in the same year. I'll show you the breakdown and the snippet in a bit. So when you're doing year-on-year comparison, normally it would make more sense than QOQ in most of the time. Why? There's a lot of companies that have, although they say they have no seasonality, but in fact, there are some sort of cyclical nature for the companies. For example, when we talk about calendar year, which is Q1 and Q4, normally it's a weaker season for some of the semiconductors company. Yes, semiconductor is sort of cyclical as well. Then if we talk about the companies with more fluctuation in their earnings, let's say construction companies, normally you need to flat out the whole year. That means that you look at the full financial year to determine whether company is growing, right? If you compare quarter-on-quarter basis, let's say if you compare a simpler company, Padini, so when would they do well? Probably Christmas, probably before Chinese New Year, probably Hari Raya. A lot of sales would come in that particular month itself. So these are the seasonality that would cause or the sort of distort how you see growth. If you compare it quarter-on-quarter basis. Quarter-on-quarter basis, it's on some rare cases. I'll give you an example. If you are investing into a commodity-based stock, let's say during the heydays, plantation industry, now you will obviously track quarter-on-quarter basis whether the company is performing well as following the CPO prices, the crude palm oil prices. Those are the rare cases where you would refer to quarter-on-quarter growth basis very closely. There are another scenario where you will refer to quarter-on-quarter growth very closely with extreme high PE company. When we talk about extreme high PE company, we are talking about 50 to 70 times in PE. Why do you look at quarter-on-quarter? Because they offer a very promising growth. Now, imagine that if I give a company 50 times PE and the company is not growing, this quarter is doing 10 million, next quarter is doing 9. So to me, unless there's a very good reason, otherwise it doesn't justify the high 50 times PE. The company need to grow consistently on quarterly and quarter basis to justify a high PE. That's where you use the YY, QQ comparison in this context, right? Then we also move into statement of cash flow. This is actually one of the most important part in the financial reports itself. Why? Statement of profit and loss, normally if the company itself, I don't want to mention any names, but if the company to a certain extent is so creative, they could find out some way to, I don't want to use the word manipulate, but they'll make the numbers look nice. Okay, they have their creative accounting. But one thing that the companies couldn't lie to investors is cash flow, especially in operating cash flow. Now, if you look at some of the companies, they are generating good profit, consistent growth, very nice numbers, very high margin. But once you look at their cash flow, they did not generate the same quantum of cash flow in comparison to their profit before tax. So when you notice that, then it means that something is not right. Why? Because if you say that you earn this amount of money, but you did not receive the cash, it's either you are unable to collect the cash back. So there's no meaning into it. Those are just numbers. Like you put out the cash outside to secure a contract. The contract gives you, let's say, a very good margin, but you couldn't collect the cash back. Ultimately, cash is still king. So you need to collect the cash back to the company itself to actually justify that, right? If you don't collect the cash, there's no meaning whatever the profit and loss that you have shown on paper. So statement of cash flow, especially operating part, is extremely important. We'll talk about it later on when we digest the cash flow statement. Then balance sheet. When you look into some of the balance sheet of the company, be very careful on some of the items. For example, like intangible asset. This can be, brand identity, IP, intellectual properties, and all, and also negative goodwill, things like that. So when we talk about intangible asset, and just happens that you value the company at a net asset, so be very careful with this kind of items, and also inflating inventories level, be very careful. Unless the company has a very good reason to inflate the inventories level of a company. If not, normally it would damage on their cash flow, right? Very simple. The higher your inventory, that means that you put in more cash into inventories, right? So the lesser the cash flow from your operation or from your operating activities. So it's a very straightforward concept, right? And also trade receivables. Trade receivables is, if you put it this way, is that if today I do business with you, but I agree to pay you in 60 days. So effectively, I am your trade receivables. You would receive money from me from trade activities, but on a later date, let's say 60 days or 90 days. In Malaysia, standard, payout is 30 to 60 days. There are extreme cases where it can go up to 120 or maybe 180 days, right? Those are extreme examples. But when trade receivable is inflating, that means that the company, unless it's growing rapidly and the company actually does very well in cash flow, normally it would mean that together with the growth of the company, is getting harder and harder for them to collect back the cash flow at the same speed, right? If the trade receivables increase too much. So be very careful on this kind of items. And also borrowings, right? In balance sheet, which I'll show you shortly. In balance sheet, if the borrowings of a company is consistently increasing or no good reason, then you need to be careful on the high gearing, because in this high interest environment, although Malaysia is not that expensive when we talk about interest, but whatever debt that you go into, you need to pay a certain interest. And interest expense is a cost to the company that will lower again your profit and loss. And the interest you need to pay with cash, right? Bank is not going to say, I'm going to give you 60 days, terms that you can pay me the interest in 60 days later. They probably apply an interest on the 60 days that they give you. So additional expenses for the company itself. So on balance sheet, be very careful on things like, borrowing, trade receivables, intangible asset. But most importantly, I think for companies, probably profit and loss and also the cash flow statement, right? And a lot of people, like I mentioned during the start of the webinar, they probably miss out on some of the notes of the financial reports, like some recent developments, like acquisition by the company. Maybe the company acquired some of the other companies that are available in the market, whether through shares, through payout of cash. Maybe the company has some major developments. Maybe the company explain why the company financial performance is better or worse than the previous quarters on year-on-year or quarter-quarter basis. So I'll show you that in a bit later. And also the prospects of company. Now, normally the prospects of the company for older and more traditional and more cost-savvy companies, they will draft the prospect by the management team themselves, right? So for example, like if I'm a management of a construction company, normally I will tell you that the outlook of construction industry is still tough. Why? Because labor expenses increases, minimum wages, and fluctuation of raw material. Because when a construction company, they go to tender, unless it's a government project where they have something called variation or something, sorry, I couldn't remember the term, that you can revise the on the contract amount that you tender based on the variation in terms of the raw material. That's a rare case. But on commercial terms, let's say if I'm a developer, I receive tender from construction companies, normally that will be finalized. The number is finalized. The construction company cannot come back to me and say that, oh, raw material price like cement recently increased by a lot, right? So cement prices increases, can I transfer the cost to you? So do you think that the developer will accept that term? Normally they would. Vice versa, do you think that the construction company will be, they're not doing charity? Obviously, they would not reverse or revert the tender amount in their tender book when the raw material prices come down. So they will tell you all these kind of things, volatility in raw material, stuff like that. And they will normally tell you the order book amount, how much order they secure in this period, and they will share with you what is their latest tender book amount and how do they think the rest of the financial year would perform later on, right? So there are a lot of these kind of things in the prospect of a financial report. So you should really go and dive very deep, go through the whole financial report if you can. Normally per quarter, it will spend like an hour or two maximum if you don't read it regularly. You need to spend an hour on it, which on 1 quarter basis, I think is quite acceptable to, you know, continuously update, to follow up on the company. Okay. So statement of profit and loss. So this is an example, if I'm not mistaken, this is taken from Corsan that time. You can look, there are a lot of lines of items, very confusing, especially if you're not from the financial industry itself. So we're gonna go into all those items particularly, then I think that they are very important for you to understand. Okay, the first one is revenue. Revenue, I think everyone here understand what is revenue, right? It's quite simple. Let's say if I am a company that's selling glove like Corsan, my revenue would be from selling glove. Sometimes the company itself, they have more products. For example, like Corsan, they have technical rubber. They also have other rubber products. So you need to find out what constitute to the revenue of a company, right? I'll give you another example, like Dufu. Dufu, although they are branded as a technology company, and where does their revenue come from? It's coming mainly from selling the precision parts of hard disk HDD. So from there, a lot of information actually you already gathered from there. In the sense that, okay, I know that this company is selling glove. So obviously I will check on a couple of items. Number one, what's the average selling price of glove now? So I can sort of predict the financial performance of the company in the future. Number two, to justify whether the financial performance of the company in this quarter makes sense. Let's say if the selling price of glove is increasing, but the financial performance of that company is actually dropping. So it's definitely the company's problem. But in this case, we all know that the the selling price of glove has been dropping. So naturally, on a year-on-year basis, you see where this is where we put in year-on-year, the revenue of the company drop, it makes sense, right? So you need to find out what is the main revenue contributor of a company to actually better understand how the company generate revenue and how do they perform, whether the performance makes sense to you as an investor or not, right? The next one is operating expenses. This is quite important. Not a lot of company, they will show you operating expenses themselves. They will normally show you remove the cost of sales and things like that, which I think is useful as well if you can get the gross profit. But to me, profit from operations is a more straightforward answer. Why? You see, profit from operations means that it's a what we call core earnings. That means that excluded some of the other non-so important items in the statement of profit and loss that would impact the profit or loss of the company, obviously. So in this context, profit or loss from operation means that from operation of making glove and also technical rubber and some other rubber related products, what is the profit that I have made before tax and before other non-related, non-operational related items? For example, like the finance cost here. So finance costs, maybe this is for non-operational financing costs, right? So you could understand what is actually the profit generated from the activities of a company, excluding some of the other one-off items. In this case, there are no specific one-off items, but in some of the companies, like smaller companies, normally fluctuation in Forex, especially US dollar to ringgit, it will cause a very huge difference between the profit before tax, PBT. But if you remove it and core earnings, remove the foreign exchange profit or loss, the core profit from operations, it will have a deviation. I'll try to show you a quarterly earnings later on where you can see the data itself. How do you deduct it outwards, right? Then you have PBT. Normally, if you ask me, we'll take PBT as benchmark or PAT as benchmark. Okay, it's where it gets interesting. Normally, I will take PBT. Why? PBT, profit before tax, unless the company that I'm looking at is constantly taxed at a 24% tax rate, which is a statutory rate, quite normal. Otherwise, I would look at the PBT if there's any deviation. For example, if the company has a now it's called MD status. Previously, it's called MSC, Malaysia Multimedia Super Corridor. Some of the companies, they have tax exemption. So you look at their PAT, right? The margins will be very high because they don't have to deduct a 24% tax rate. And if you take that PAT, you compare to the company's peers that does not have MD status, right? They are taxed at 24% tax rate. So when you compare both, you will find that one company, they enjoy superior PAT margin, but the other company actually doesn't enjoy the superior profit after tax margin. So it will cause perhaps a misconception in between the comparison between companies. Okay, so I'll take PBT normally. And also to be very careful when you take PAT, like MD status, you can renew 2 times maximum, 5 years and 5 years. Imagine that when a company, let's say Egmore, right? Again, it's just an example. Egmore, their MD status, if I'm not mistaken, has expired. So you can see that there's a sudden drop on quarter-on-quarter basis in terms of their financial performance. One of the reasons is because their tax exemption period ended. So it will look like the company, even on flat basis, it will look like the company PAT actually suddenly dropped by 20-something%. But in actual terms, it's just the changes in terms of the tax benefits that the company is enjoying. So be very careful when you use PAT. So another thing that apologies, I didn't really box it up, but the earnings per share is very important to for investors to follow up, because sometimes when we only look at the net numbers of company, let's say PBT, PAT, right? Sometimes the company, they issue new shares, for example, like private placement. So for those who don't know what is private placement, is that the company, they issue new shares in order to raise fund for the company. Normally, as per the mandate, 1 year, they can issue 10%. Anything more than 10%, they have to call for an EGM for investors' approval. So when you issue new shares, it will dilute your earnings, right? To put it this way, not a slice of cake, a whole cake, if you slice it into 10 pieces, so everyone get 10% of the cake. But if you dilute it further to let more people benefit from it, let's say slice into 20 pieces, you have more pieces, but at the same time, everyone's portion has been diluted. So in the sense of earnings per share, it's the case where the company can raise fund from selected investors through private placement, but at the same time, the investors who are already invested into the company, they can use the cash. I mean, effectively, it's the company that use the cash, but you as a shareholder, you would piggy right on it. The effect on it would be diluted on your earnings per share, net asset per share. So that's what you would be affected in that sense. So look at the EPS of a company, earnings per share of a company, whether it increases or decreases. That's a very good benchmark to the net earnings per share that you as a shareholder would be contributed. In this case, unfortunately, you are attributed to a loss per share because the company is in loss. So when the loss divide by number of shares, so naturally you get a LPS, loss per share. But in normal cases, in normal companies, normal circumstances, it will be EPS, earnings per share, right? So you can track whether the company had additional dilution from their recent activities. Let me give you an example. Like in this case, let's say the EPS of the company, the last column, the last row of this P&L, it shows that the EPS of the company for last year's corresponding quarter is 1.8. Now, imagine that the profit after tax of the company actually increases, let's say increase to 80 million. But in this period of time, over the span of a year, the company actually issue new shares that double the total number of shares right issue through another instrument of issuing new shares to raise fund for the company. So the company goes through a right issue and the EPS actually double. So what do you think will happen to the EPS itself? The EPS will actually decrease on a year-on-year basis. although the profit had increased, but your share of a portion of the profit as an investor actually decreases. So you need to be careful on that, whether the net EPS effect after a fundraising activity or a corporate exercise, whether it increases or it decreases. If it decreases, probably is not the best outcome for you as the investors. Okay, so be very careful on number itself and also the per share level. Okay, so pardon me, let me drink a bit of water. Okay, next up, we actually look into the statement of cash flow, where cash is king, where it's the critical part where we can look into whether the company is generating cash or not generating cash. Okay, so in this case, it's quite clean cut that you can see here. This part, net cash from operating activities. So you can see over here that the company is generating 35.5 million throughout the operations of the company. Although they are losing money before tax, they are losing 16.4 million on PBT. This is not single quarter, by the way. When you look into cash flow statement, normally it's the stacking up of quarters for the financial year. Let's say this is the Q3, so you could expect there's a total number of cash flow for the 3 quarters. That means 9 months, right? If you're looking at Q2 of the company, so probably 6 months. Okay, so if you want to do a isolation of that quarter itself, you have to do a Q2 versus Q3 comparison. You have to minus off. So it's a bit complex. Normally, I would just look at because cash flow in Malaysia doing business, you have terms and things like that. So I just go with the flow. I'll look at the let's say 6 months, 9 months. What is the latest status of the cash flow activities of a company? So in this case, from operating activities itself, this company generated 35 million. Now, if you look at the year before that, okay, the year before that, corresponding year, the company actually paid out 244.8 million, okay, in terms of the operating activities. Now, I'm not sure why they put dividend paid in this column of items, right? But in that year, although they earned a lot of money, but at the same time, they also pay out a lot of dividend, right? So, and this is a symbol that the company actually, they pay out more cash than they actually generated in that period. So be very careful with it. Although you see the profit or loss of the company is doing very, very well, but if they have an issue in their cash flow, so eventually they will need to go to fundraising activity, and then your EPS, earnings per share, you as a shareholder, your rights per share will be diluted. So it's a chicken and egg problem. Lack of cash flow, fundraising, reduction of per share. There are a lot of companies in Malaysia that actually go through not once, not twice, but multiple times of fundraising. If the company, again, the EPS generated is higher and higher, then it's okay, it's acceptable for me. But if the company is on a constant state of lack of cash flow, especially from operating activities, obviously, because it is the business of a company that generate the cash flow, right? So if there's a lackluster in ability to generate cash flow, normally I would not invest in the company itself. It's a red flag for me, definitely, unless they have very, very good reason for that, right? So net cash from operating activities, always check on that, whether they are having positive numbers. If they are having negative numbers, so be very careful, monitor them for a couple of more quarters, whether the cash from operating activities actually makes sense, right? Next up, this is CapEx, capital expenditure. In more formal terms, in the cash flow statement, it's acquisition of property, plant, equipment, what we call PPE. In very simpler terms, when a company is going to expand, when we talk about the manufacturing sector, so what you need to do, you need to invest in a piece of land, or you take over a existing factory or warehouse, whatever, and you need to buy more machinery, right, to expand your capacity. The higher your capacity, the better the demand, so naturally the better the revenue and profit you could generate. So for a lot of analysts, actually capex is an indication of a company whether they are going to grow in the future or not. Right? Let me give you an example. If a technology company, they do not give you a lot of information, but in their cash flow statement, suddenly they have a huge capex, which they buy a lot of equipment out of nowhere. So do you think the management of a company, they will deploy a lot of cash into buying property, buying plant, buying equipment, if they do not foresee a huge order book that is coming in, right? If you look at some of the prospectus, the prospectus is the booklet, not booklet, sorry. It's basically the information that a company that's going public, they will have a lot of information declared. Normally, the fundraise will be deployed into growing the company, which is capex. So in prospectus, they explain very clearly why we will, what kind of equipment we will buy, what kind of property we will buy, what is it for. But in quarterly report, normally they do not show that. They only show you the number one line. That's capex involved 30-something million. They do not break it down into whether it's property, whether it's machinery. So you as an investor, you need to be sharp enough to constantly follow up. If you constantly follow on a company, for the past few quarters, nothing happened. But out of nowhere, the company had a outflow of cash into deploying into capex. Then you know that probably the company has something going on that you can investigate further. There are probably new order book coming in, possible, or maybe just refurbishing the equipment. Like in this case, probably it's a refurbishment of equipment because the numbers is not too big of a difference from the previous years. And also you need to check on annual report how many years has the equipment has been used. Okay, so if it's very old, probably it could be a replacement, but most of the time it would be a new expansion if you see a significant increase in the capex fund, right? Then normally I would see in financial activities, normally I would see whether the company had increase of bank borrowings. That could also be seen in the balance sheet, which I will talk about in a short while, right? And normally I will also look at whether the company, how much cash they have in their hand as compared to their borrowing, especially short-term borrowing. So what does short-term borrowing means? It means that the company have to pay back the loan within the next 12 months. So if the cash of the company is insufficient to pay off the short-term borrowing of a company, then they might have some problem. So imagine the bank comes to them within the next 12 months, and the company suddenly say, "Oh, I cannot afford to, pay back the bank borrowing for the short term." So what will happen? Normal cases, there will be a penalized in terms of interest, but for listed company itself, default on payment could mean PN17 or GN3 status. So PN17 or PN17 is for main market companies. GN3 is for ace market companies. So if they were to fall into that category, that means that normally they are in financial distress. So what will happen to their share price? It will be a landslide. So be very careful on whether their cash flow would be able to cover up the bank borrowings. Let's say the terms default means that you couldn't even pay off your monthly installment. So it's a quite serious issue for whatever companies, whether listed or unlisted, right? So next up will be the balance sheet. Some of the items like other investment. So in some extreme cases, some of the companies, they actually have some funny other investment that they do not disclose. So as an investor, you would want to know the company that you invested, where do they deploy their capital, right? So other investment normally doesn't justify where the money goes. So I'll be very careful on things like other investment. And also you see under the line there, there's actually a goodwill on consolidation. So it's a bit complex. I'm not going to touch on the goodwill part, but intangible asset, goodwill and consolidation, if they are too huge in a balance sheet of a company, be careful. There might be adjustment to the profit and loss eventually, right? Especially on goodwill. So intangible asset, be very careful. What are the intangible assets of a company, whether it's justified? So for example, a OEM manufacturing company, that means that if I'm a brand owner, let's say Nike and Magnitech, a company in Malaysia, they manufacture the shirt for me, but I put on my logo myself. So Magni will be the OEM. So let's say OEM companies, normally they would not have a lot of this kind of intellectual property, or they would not have a lot of this kind of brand value. So brand value normally we'll put it into intangible asset. So in that case, if a OEM company suddenly they tell you we have a huge intangible asset from, okay, if it's technology know-how, probably it could be justifiable, but when they tell you brand value, it probably doesn't make sense. So be very careful with this kind of things that it's very hard to gauge, intangible asset and stuff like that, right? So again, trade receivables, we had mentioned when we came in, be very careful with trade receivables. It's quite dangerous to the company. And lease liability is something new. It's the recent MFRS 16, Malaysia Financial Reporting Standard 16, recent changes on how a company would treat the lease expenses. Let's say rental agreement for next 5 years. So what is your liability? Because basically it's a indirect form of fixed liability for you. You have to pay it off. So now they define into the liability part of a company. Previously, I think before the downfall of AirAsia's financial performance time, the lease liability, it's something like an off-balance sheet items, but that was the old days, right? Then bank borrowings of a company, whether the bank borrowings of a company increase significantly, especially in the current, let's say, the next 12 months period. So be very, very careful on these lines of items. Okay, now to a little bit more interesting items like the financial report. So for this company itself, like Kosan, like I mentioned just now, they explain to you what is actually going on to the company, like technical rubber, what happens in that period. So in this case, it's talking about first half. First half means that 2 quarters, Q1 and Q2 together. What actually happens to the company? Technical rubber performance was this and this, then glove segment was this and this, then clean room. Sometimes they have other businesses that contribute significant to the company. Now, this part is actually, to me, is the most important thing that you need to look at during glancing through the financial report, because this is where the company will explain to you why the company actually performed like this and this in this financial quarter as compared to a year before or a quarter before. If you do not go into this part, just looking at the numbers, for example, if you look at the numbers, that it shows that the company had a dropping in earnings, but in fact, it is a one-off effect due to some items. Let's say they dispose of a loss-making business, so there's a one-off expenses. Now, if you do not look into that, you might think that the company do not have a very good value in it. Let me give you an example, SMRT. SMRT, if you do not go deep enough to look into each of their business segment, whether this business is profitable, but education is probably not so profitable, so they dispose it off. After they dispose it off, when they become a technology company, re-rating will happen in terms of valuation. So that's where the magic of share price happen. So be sure to go deep enough into the notes of the financial report to understand what is actually going on with the company, right? Lastly, we have prospects. Like this part, normally bigger companies, they will explain to you what happens in the industry, what is their capacity, like what is the order book, what's the tender book, things like that. They go into very in-depth kind of level to actually explain to you. But unfortunately, a lot of smaller companies, they might not have the capability. They just put 1 or 2 line of items, which saying that the outlook of the economy is very challenging. So probably our upcoming financial performance will be cautiously optimistic. Normally, they will use this term, and it's very hard for us as investors to justify what do you mean by cautiously optimistic. Are you optimistic or are you not so optimistic? So you have to really look into some of the peers' performance or the prospect parts of the peers to understand deeper to the industry to actually have a better understanding on a holistic view, right? Okay, let me quit sharing on the slides. I'm gonna go into sharing my Chrome. Okay. Shane, give me a bit of time. We jump into Q&A very shortly.
No worries. Take your time.
Right. Okay. So this is Dufu, a technology company that we had mentioned previously. I think you guys can see the window, right? Right. So the revenue generated for the company, if you compare year on year, okay, year on year, it dropped by, I think, by almost half, and huge, very huge drop in gross profit level. Okay. Now, if you look at the cost of sales of the company, right, there's a huge difference between the quantum of dropping in revenue and profit. Revenue probably dropped by approximately 50%. But if you look at the gross profit, the drop in gross profit, it's probably a drop of quantum in, I would say 60 plus percent, 70, I don't know, around that figure. So that is because it involved the fixed cost of company. In every company, there's a component called fixed cost and variable cost. Fixed cost is what you have to pay no matter what is your level of operation. For example, your rental, some of your headcounts, and some of the baseline inventories level that you have to buy. Your utilities. Utilities might increase, but there will be a base level of maintenance in terms of your costing, fixed costs, and variable costs. The higher your input, that means that more inventories, more worker, more utility expenses. So there will sunk into your higher cost if you have a higher revenue. In this case, you can guess that the fixed cost of Dufu per quarter probably is around 35 to 40 something million. So it's very borderline profitable for them in this quarter. Then if you look at other operating income, probably this is foreign exchange profit. Then you look into their profit from operations, is quite a significant drop. So what they'll do next, very simple, go to the explanation notes of a company, right? Okay. So they will tell you it's decrease in revenue related to HDD components and sheet metal, right? And they also mention another thing is that operating costs increase, labor, again, minimum wages increases, energy because of the ICPT, I think expired, ICPT expired. So for all the industrial players, the expenses in terms of their, what we call the energy utilities level increased significantly and drop in economies of scale. Like I mentioned just now, fixed costs, if you don't have a substantial revenue to cover it up, so your cost per unit would increase. Economy of scale basically means that the more unit you produce, the lower your cost, because fixed costs, they're fixed. So the higher number that you produce, the lower per unit of cost that you will incur in that case, right? Then if you compare on last quarter basis, right, you can see that significant drop in revenue as well, right? Also here, lower production output. That means that probably it's because their client order lesser. Like actually the E&E, you can relate to E&E industry. Had you bought a computer in COVID times? Most likely yes, or last year or the year before. Now, will you change your PC in this year? Probably not for some of the people, because I just bought last 2 years ago, right? So it's somewhat cyclical basis for consumer industry. So if I'm not mistaken, Dufu, their end consumer is partially also to the consumer industry as well. So they are naturally affected by the end consumer part. So if you link things like that together, you could probably guess or expect the financial performance of a company. Of course, now we are talking in hindsight, but going forward, you can look at how the sales of HDD, some of the companies overseas, right? Let's say Seagate. Let's say Seagate, some of the companies, you can refer to their financial performance and look back into some of the companies that are involved in HDD industry in Malaysia. Dufu, JCY, Notion, these companies, you can refer back. And ultimately here, you see they do mention that reduced capacity for demand for HDD and other semiconductor related fabrication has been affected, right? And ICVT is the electricity cost that mentioned just now. I think it happens to all the manufacturing companies. So yeah, it's quite common over in the industry. Then just go back and look at the cash flow. How is the company faring in terms of cash flow? Okay. So actually for this period of time, 6 months ended, the cash flow generated for the company is still okay compared to last year. They are still getting around 10 million and they have around 88 million of cash on hand, right? Is there significant capex? No. Last year, probably they bought more machines, but this year, 4.8 million is probably refurbishment of machinery and things like that. And so we look at their bank borrowings. Loans are borrowing 1.6, 46, so they have sufficiently more cash on their hand to actually cover up the loans, long-term loans. This one is long-term, more than 12 months. For shorter term, definitely they have no issue on paying off the short-term liabilities. So they are still financially sound in terms of cash flow, but probably not so in financial performance. So if you look at the share price of DuFu, probably they also dropped in the past past few days, trading days. Sorry, a bit slow on my end. Okay, so yeah, the share price has been dropping for a bit. So obviously it doesn't meet the expectations of the market in this case, right? So that's the case for DuFu. Okay, so maybe we move, we have a bit of time left, probably we move into Q&A now.
Sure, thank you so much, Max, for doing this segment for us, breaking down financial reports. So if any questions to ask our speaker today, you may write them in the Q&A box here. Don't write them in the chat box, write them in the Q&A box. Okay. By the way, Max, I think the DuFu is in industrial product and services sector. First question from TH is that when it comes to judging the health of cash flow, is there a ratio between the profit before tax and the net cash from operating activities?
Yeah, I think Theo, I don't know whether it's deja vu or what. I think this question, we did it in the last session as well. And my answer at the time is 70%. Approximately net cash from operating activities, because there are trade receivables and also things changes in inventories. So probably around 70% is quite okay for me in that sense. So yeah, so around 70%. But anything lesser than 50%, then you have to really look out. Let's say the company is earning PBT level is 100 million, but they are reporting a 50 million in net cash from operating activities. Still good, but probably there should something that you should monitor, whether it's the inventories level of a company or the trade receivables of a company. You really need to look out.
Right, thanks, Max. The next question is by Sam Nair. How do we know that the CAPEX investment is for expansion purpose and not for investing purpose?
Oh, you mean like if they were to buy a property and the property is actually for investment purposes. So you can actually match back the PPE part. If they were to buy the property for investing purposes, then investing properties part of a company will increase. But if the PPE of a company part increases when they incur the CAPEX, then you will know it's probably for expansion or what we call maintenance CAPEX. In the industry, there's something called maintenance CAPEX. It means that every year, I have this factory, I have this number of machineries. I will still need to incur 10 to 12 millions to refurbish, to upgrade my machinery. So that's what we call maintenance CAPEX. So if you see there's an increase in the line of item balance sheet, investment properties increase, and you see there's a CAPEX going on. So probably that CapEx investment is into investment, is not into expansion, but into PPE itself, then probably is for investing purposes.
Thank you so much, Max. The next question is by Victoria. May I know what are the factors that will affect the company valuation and the relationship with the share price? How do we know if a company is undervalued?
Wow, that's a very big question. So maybe we go on with the factors that will affect the valuation first. So where does valuation come from? It's normally it's from the ability to earn money, whether it's earnings or the ability of what we call generate cash flow from a company. Then the market will value the company based on it. That's where PE come in. Let's say if a company is able to earn 100 million per year and the company is valued at 1 billion, then the PE is 10 times. That means that you are buying the company at 10 times of their earnings power. There's also a saying that if you buy this company, you get your return in 10 years, PE of 10. But naturally, unless the company, you receive the 100% dividend payout, let's say they earn 100 million every year, and you get the return immediately. Otherwise, in that context, it's not really return in 10 years because they would still need to reserve some cash and you will not receive your 1 billion by the end of period, unless you take over the company, the whole company. So normally, PE is just a benchmark of how many times of earnings that you are willing to pay to a company. That's a valuation. There are also other valuation like dividend yield, the yield of company. Let's say if I buy a company, 1 ringgit, then the company pay out 10-cent dividend. So the dividend yield of a company is 10%. Your return per year on dividend alone is 10%. So that's one of the way of valuation. There's also valuation in terms of the NTA, the net asset of company. Let's say if you expect the company to go privatize in someday because the market undervalued the assets of a company, you expect it to go privatize at some point, then you can use NTA to value the company. Now, what is the relationship between share price? We talk about how does the fluctuation of share price come in first. In the short term, the share price is actually a function of supply and demand. It's nothing else. It's pure supply and demand. The higher the demand, the higher the share price, it will move up. The shorter the demand, it will move down because the supply is stronger. So if you see a company, let's say in your case, valuation is attractive because now the company is trading at 10 times PE, then there are suddenly news that saying that, oh, Tesla is coming to Malaysia. This company is probably going to get benefited. So you know that the earnings of a company may increase. And this would push up the demand of the company and the future valuation, PEG, price earnings to growth of a company. It would positively impact the share price. Now, vice versa. If you know that this company is going to lose out a huge client, so you know that the earnings of a company probably will drop and the valuation is lower. And the supply of the share of a company would obviously increase. It will drive down the share price, right? So how do you know a company is undervalued? I think that's a million-dollar question. Unfortunately, I have no golden answer for that. It's very subjective. What do I mean by subjective? This company, if you understand it well enough, you might think that it's undervalued because the market do not know how to value it. But you have to figure out how long would the market takes to figure out that this company is undervalued. Okay, what kind of you need to understand why is the share price depressed now? Is it a one-off reason? Is it because of market sentiment? People prefer to invest in other markets, or because the market is right? Sometimes the market is right, sometimes the market is wrong. So you need to find out the reason the share price is depressed, or what we call in the context is undervalued. Then you have to find, it depends on how well you understand the company. Let's say you know that 1 year down the road, the earnings of a company would double and the valuation now is single digit. So in that context, yes, obviously it's undervalued. But if you think that this company is not bad, I understand what they are doing quite well, but I cannot clearly expect what is the earnings of the company for the next financial year, then the company is trading at 20 times P, probably it might not be undervalued. So it's a very, very subjective question. It will be depending on how well you understand the company and how the market look at this company itself.
Thanks so much, Max, for giving a very good answer to that valuation question. All right. I think if I may add on, typically, if it also depends on the nature of the company. If the nature of the company is more capital intensive, that means it relies more on tangible assets to generate returns, to generate sales, then you typically will use like NTA, like what Max said, or the price book ratio. So this is also another consideration, like which valuation metrics should we use. The next question is by Zul. How do we screen potential good companies?
Right. One of the way that you can, this screening, right? Screening is another whole topic itself that deserve another sharing session, right? You need to screen on ROE, return of equity. You need to screen on the PE of a company, screen on the market capitalization of a company, screen on the EPS, dividend yield. There are a lot of metrics that you can screen on a company. So generally speaking, normally I would screen on very macro basis. Because I have more time, because of the nature of my job, I have more time to actually go into the financial results one by one to actually screen the companies, whether this is an opportunity for me to leverage on, or this is a naturally bad quarter itself. So if you say you do not have so much time to actually screen, so another way is that determine a valuation that you can accept. Let's say PE of 15 times. So let's say if you don't want construction industry, or you don't want specific industry, plantation industries, cyclical industries, so you can select, let's say, industrial industry like Shane pointed out just now, DoFu, or a consumer industry, or maybe finance industry. You can set a P valuation or dividend yield and then filter out all the companies and then go into them individually one by one. There are some websites that offer very useful screening, which is how many years their earnings has been growing on year-on-year basis. I think, I don't remember correctly, but i3 or Calci Screener, they offer this function. For the past 10 financial years or past 3 financial years, are they growing their EPS year-on-year basis? So when you screen that, you'll know that whether the company has been growing for 3 years, the past 3 years. If yes, probably the company is something that you are looking for. Definitely, the company is growing itself. So these are some of the things that what we call that you need to go through in the screening process. But if you have the time to dive down into the quarter report or the annual report of the company, it will be better. And if you really do not have time to filter companies, you can actually look at the analyst report. Whatever your broker is, there's definitely analyst report. You can look into them and then you study. They already done the homework for you. So it's much more easier if you go through that path.
All right. The next question is by Kochin, and this question in relation to free cash flow. All right. So the question here is, could you please illustrate with an example, how do we calculate the free cash flow per share of a company from its annual report?
Okay, so to calculate free cash flow, let me go one step by one step. First element you will need is that you need the net cash from operating activities of a company, right? Naturally, you need to get the net cash from operating activities. Then you deduct by the capex part that we mentioned just now, right? We mentioned how to look for the capex, which is acquisition of PPE. You deduct that amount, then you get a free cash flow. Okay, that means that after the capex expansion of a company, Some people, they will also deduct the paying off debts. Okay, it depends on you, but I would recommend deduct the capex part. So after you deduct, how much cash the company has on hand that's free to deploy after deducting the capex part. Then you divide by the number of shares outstanding of a company. Let's say 100 million of free cash flow, divide by 100 million shares of a company. So per share basis, the FCF free cash flow is probably 1, right? But obviously for actual case studies, they won't be 1. There are sometimes even the free cash flow could be negative because the company are expanding. Maybe they have a positive number, net cash on operating activities, but they take in a bank borrowing for expansion purpose to go into capex. And in that case, you get a negative free cash flow. Then the next question comes in, is negative free cash flow is bad? So the answer is quite subjective. If the company is taking the money, free cash flow, reinvesting back into the business to grow, then probably it's a good thing. But not all investment is successful. Why? Let me give you an example. Now, the industry might be looking good. Like a lot of things are, looking rosy picture. The industry is growing. So the company, nothing wrong, planning for capex expansion, buying more machineries, buying more land. But something happened, like unexpected black swan event, like COVID happens. So suddenly the demand vanished. Your capex investment becomes an additional cash deployment outflow to the company, but at the same time, more depreciation for you. So it will become a net expenses to you on the profit and loss and also cash flow level that would impact your valuation again and then on your share price. So SCF is a very good benchmark on whether the company have free cash flow for doing something else, for example, like giving you back some of the dividends. But I think it's more important to look at whether the company generating cash flow itself and then how much of capex they deploy and whether their deployment makes sense at a point of time. If you see that the industry growth is probably coming to an end, but they're still deploying cash flow aggressively, unless on individual basis, the company itself have a long-term contract, probably they might not hit the optimal utilization rate of their new capacity installed in that case.
Thanks for answering the question. So you can actually obtain both figure, which is operation cash flow figure and also the capex figure from the cash flow statement. Okay, just refer to the cash flow statement to obtain these two figure, and you do the subtract. Then you'll be able to get the free cash flow per share. Free cash flow you divide by the total outstanding shares. The next question is by Victoria. For public listed companies, how do we know that the directors' remunerations are fair?
Okay, some company pays the director higher than shareholder. Okay, I think which companies that we are referring to, right? There's an article by The Edge, the top 10 paid company directors in Malaysia. How do we determine is it fair? To me, I don't mind the company paying the directors handsomely. I really don't mind. The problem is whether it justifies the growth of the company. Let's say this year, the company is growing by 10%. Your directors are compensated extra 10%, fine, makes sense because the company itself is growing, right? But if the company is making loss this year and your directors are still paying on single level, is still paying a figure, so it doesn't make sense for me. So my question will be, what do you deserve? Yeah, 8-figure payout, okay, that you make the company loss. As a shareholder, I wouldn't be justified. So normally high 7-figure, I will be quite furious already if it's a loss-making company. Normally, I will determine whether the company is growing. If it's growing, then compare year-on-year basis. Again, you can find in annual report. If it's going in tandem with the growth of the company, fine, I can still accept. But company grow by 5%, your remuneration or your bonus or whatsoever increased by 30%, then it's not justified. It's definitely not fair to you as an investor itself. No, there's no rule that the director have to cut salary when a company is in crisis, there probably will be voluntary cut by themselves if they themselves are major shareholders. But in normal culture, let's say the CEO, unless they are compensated by shares or other form of compensation, normally they would not go for a voluntary cut in terms of pay, because company level is company level. Professionally, they are managing a company, but they still have their own interest to take care of. So, sorry. The benchmark is still on, to justify whether the payout is making sense, proportionate to their profit. Let's say the company is earning 10 million per year, but paying out to directors itself is already 10 million. So it doesn't make sense, It's making huge revenue, but low profit margin. One of the reasons is because hefty pay to the all-star management. There are companies like that. So it would not justify. It's very case by case basis.
Yep. So use your common sense and judgment. The next question is by KC. After you break down financial reports of a company and found questionable numbers, how would you go about doing it as a minority shareholder besides selling the stocks?
The number one thing probably is question them on AGM. If they were to answer you, because now they can go, some of the companies, they can go virtual and they would choose to, ignore some of the questions by the minority shareholder. So it's quite sad to say that your answers or your queries might not be heard. So, but if you say besides selling the shares, if you have a very huge portion in it, then you saw something really questionable or funny, there are a couple of things that you can do. Probably one, report to MSWG, Minority Shareholder Watch Group, and two, probably go to the AGM and question the management directly. But if you hold a substantial, maybe if you're in the top 30 list, probably you can just call the company IR department and you can tell them, I'm a top 30. I want to know what is actually going on into the company, specifically on this item. But unfortunately, if you're holding too little of shareholding of a company, then probably they would not entertain you that much. It's a reality in the market. So another thing is that if you really unsatisfied with them, but you hold a substantial number of shares, if I remember correctly, it's around 10 to 15% of the shares, you can call out for an EGM to change the board of directors. So there are some of the things that you can do. But if you're asking this question, probably besides selling the shares, I presume you have some reasons that you couldn't sell the shares. Perhaps the portion is too big, the losses is too big for you to, just sell and then move on. Then probably you can actually, if you're top 30 or you're close to top 30, you can actually call in and say, hey, I have, let's say 500,000 units of your shares. I want to know what is going on this item. Or at the AGM, question them directly. Best if you could attend the physical AGM, because they cannot avoid your question over there. They can give you official answer, but probably if there are a lot of people asking, they couldn't avoid it as well. So when you see funny things that are on the company. Yeah.
All right. Thank you so much, Max, for sharing your perspective in this issue. Let's do one last question because time is running out. Are the analyst reports accurate? Will it be inflated by the writer for obvious reasons? What is your thought?
I think it depends on, I can say that, yes, you're right. Probably some of the writers, they have their personal agenda, but it's illegal, and they have their personal agenda. It's called front running, if you're referring to that. So normally they wouldn't do that, right? Whether it's accurate or not, it depends on the writer itself and whether the valuation makes sense. Last time, many years ago, when the distribution of information is not so advanced, there are some analysts actually, inflate the valuation of company for no reason. Not for no reason for you and me, but there's a reason for him, right? But now that all the regulations are more tight and actually monitoring and compliance governance is actually very strong now. So if you do some funny things, it's very easy to catch, right? So whether it's accurate or not, it depends on what kind of report it is. If it's a very in-depth report, let's say more than 10 pages, it explains from A to Z what is the business model of the company, then it's up to you to digest whether it makes sense or not in terms of the growth. Bear in mind that whether it's our judgment, the expectation of the management in prospect, or the write-up by analysts, we are still human, we still make mistake, right? Things might not happen the way it should be. Like, for example, like if the company plans, let's say the management told this analyst, okay, I'm having this capex, expected to contribute to my top and bottom line, revenue and profit by the next year. But then the machinery delayed. It came in 3 months delayed. So, you expected the EPS to kick in by the next financial year, Q1, but it only come in Q2. So who's in fault? Is it the company, the supplier, or the analyst? I think it's a market issue. It's not accurate or not. It's not the issue of accurate or not. It's something that you need to continuously to follow on. So best advice I can give is take all the information from the analyst report and then add on to your own study and then see whether it makes sense or not on the valuation itself. That's the best method that you can apply, because if you add in your own judgment, it's probably you will take responsibility of it most, rather than analyst A say buy, then you buy. If things happen, surely you will make a wrong decision on it. So it happens. Yeah, so better if you take the information and add it on to your own analysis.
Wow, there's a solid hour and a half spent with Max today. So ladies and gentlemen, you just heard from Max Tan, who is the founder of Want2Invest. So thank you so much, Max, for sharing with us how do we break down financial reports.
Thank you so much, Shane, and thank you everyone for listening in. Hope to see you guys in the next session. Thank you very much.